Hey everyone, the life of a South African trust has changed forever. Because a trust is a taxpayer of last resort in South Africa, it was often abused in the past because other people pay taxes first. Now it actually requires a lot of planning, record keeping and reconciliation, which is more important than ever before. The problem is the poor tax practitioner, after all these changes, are now becoming the finer checker and balancer of a trust complete compliance in terms of the trust deed and in terms of our law. For example, we now have to provide minutes to SARS of transactions in a trust. So therefore, the poor tax practitioner now has to double check the trust deed and make sure that they actually have all the sets of minutes in terms of what the trust deed requires. And now the poor tax practitioner has got individual registration as a tax practitioner. So I hope these people have actually got proper PI cover, because SARS can actually come after you. It started many years ago in the Davis Tax Committee years, around about 2014, 2017, where SARS started digging into trusts and asking a lot of uncomfortable questions. Have made certain changes, including Section 7C at the time. And then around about 2021, SARS got out of the blocks again, and they actually ran a webinar, which was the second one in a series of a number that they ran. That happened on 29 July 2021, and they labeled it Trust and Tax Obligation. Fast forward a little bit, on 28 September 2022 last year, they actually issued a media release with the heading SARS sharpens its focus on trusts. Then we started hearing about the new IT3T, where trustees have now have to report distributions to SARS, because there was a big gap that SARS identified of distributions made by trustees, and those ended up on beneficiaries' tax returns. Then the grey listing noises started being made, and obviously trusts were highlighted as one of the vehicles where there could be potential abuse. And we're thinking immediately the beneficial ownership requirements, which SARS now also want that reported. A couple of days ago, on 31st of August, SARS issued a communication type of clarification of certain matters pertaining to the completion of the trust income tax return, making it clear that they are after certain information. And SARS fondly refers to some of these questions being asked in the tax return as risk questions. So we are going to dive into the trust deed and start asking the questions. Why is SARS asking these questions? What are the repercussions? Are we ready to actually disclose the information? If we haven't disclosed the information correctly, and then I immediately think about the attribution rules, which haven't been applied by accountants consistently in the past. That is, for example, one specific set of risk questions that SARS included in the new trust tax return. So you're going to have to know your stuff once you're actually ready to complete the trust tax return. And remember, a trust is a taxpayer of last resort. Other people pay taxes before that. If you're going to jump out of woodworks now to start complying only from this year, and for example, the attribution rules have been in operation for many, many years, what are we doing? Are we considering a voluntary disclosure program? What do we have to do? And do we realize, as we answer these uncomfortable questions, which a lot of people are not even aware why SARS is asking these questions, are we ready to actually deal with the consequences? And then we are also going to talk about specifically, if things go wrong, what would the consequences be, both for the tax practitioner as well as the Board of Trustees. So please join me for a jam-packed session where we're going to dive practically into what all these changes mean and what trustees and tax practitioners have to start thinking about when they touch a trust tax return.